Hello and welcome to Mindful Money. I'm John Lappin, editor of Mindful Money, and today I'm talking to Chelsea Financial Services' Darius McDermott about the options for this year's ISA season and where investors might want to put their cash this year. Hello Darius.
Hello John.
So Darius, there are different sorts of investor really, so they may have a big portfolio already, or they might just be on their first or second or third investment style ISA. What do you think the sort of options are this year?
Yeah, I think investors need to consider sort of two things with any investment that they make, whether it's an investment to a larger portfolio or a first-time investor, is how long are they looking to invest for, and really you're talking minimum. If you're not looking to invest for a minimum of 5 years, maybe an investment ISA is not the right product for you, and sort of what level of risk you're prepared to take throughout that time period. So I think those are two key first questions for any investor to ask, whether an experienced investor adding to a portfolio or a first-time investor just looking to make a small and moderate lump sum investment.
Okay, and this year, what do you think's a good example of a nice, solid, decent sort of fund that someone should be looking for?
Yeah, we generally favour, on a sort of a 12-type month view, we generally favour developed market equities over sort of Asian or emerging market equities. So something like a global income fund, Artemis Global Income or M&G Global Dividend, two good, solid, core global income funds. You're getting access to a bit of diversification via the global nature of those products, but also they are seeking income type stocks that tend to have good cash flow and are able to pay out a dividend. So those would be two sort of core global income type products, which I think may be of interest in the coming ISA season.
Okay, what's just a little bit on the difference between the two as well?
Yeah, the Artemis fund, is a solid, slightly higher income, sort of paying out sort of north of 4, whereas the M&G fund looks to buy companies that actually are looking for dividend growth. So they're much more likely to buy a company, or much more probable to buy a company that's got a lower yield today, but that income growth is sort of core to their investment strategy. So they also look for companies which make good returns on their investments within their own businesses. So pretty much every income fund looks for sort of income growth, but that's a real sort of feature of the M&G Global Dividend, and as a result will have a smaller yield to begin with.
Okay, so that sort of covers the income argument off. What about growth then, if you're looking for growth, if that's your main objective?
Yeah, if we stick with a global fund for argument's sake on this particular, we like Rathbone Global Opportunities. That has got about 65-70% in large cap, but the balance then tends to be in mid and smaller size companies. So you get a little bit more oomph and potential growth. Also with that comes a little bit more risk, because the smaller a company is, you do get a bit of liquidity risk in a portfolio. Again, it invests globally in developed markets. It will invest in businesses that are interested in emerging markets, but they tend to be developed market listed. So
do you think this ISA season is something where you would say stay away from the emerging markets at the moment, because there's a lot going on and a lot of places are working out where they are economically?
There is, and there's also a lot of currency rebalancing going on in some of the emerging markets as they're trying to get a fair level of their currency, primarily versus the dollar. I think if you said I'm a higher risk long-term ISA investor, that actually emerging markets do have attractions on a valuation basis. They are cheap versus their history. China and Russia particularly. Brazil had a very poor year last year, so sort of some of the big emerging markets are cheap. But I take what you said in your sort of introductory remark on the question, which is there's not a lot that makes me want to buy them in the short term. So if I'm sort of thinking 12 months, I prefer developed markets. But if I'm taking a very sort of medium to long term view, you can certainly see attractive valuations in emerging markets.
Okay. Now we've dealt with a little bit in terms of, well, maybe you should be in a cash ISA if you have a very, very short term horizon. What happens if you're a sort of low risk investor, but you want to be in some sort of fund, you want to be in an investment ISA? What sort of fund do you think they should be looking for this time out?
There's a number of different ways. Tends to be investors look at sort of UK income funds. Funds that have income attached to them, I mean, dividends make up 2/3 of long-term equity return, and by long-term I'm sort of talking 40, 50 years. That compounding of dividend is a very strong way to get stable growth. Obviously, for those requiring income, can take income today. But people might also consider a multi-asset fund. Things like HSBC Open Global Return is a sort of a global multi-asset fund. It has some equities, some bonds, some property and alternative vehicles, and then they hope that the smoothing of those correlations work well in combination to give sort of a lower risk growth profile.
Okay.
So something like that might be appropriate for a low risk investor.
Okay, and if we move to the middle of the scale, then what about a middle risk investor? Now, obviously that's slightly different for different people, but in general terms, at medium risk, and what do you think?
I mean, so we've said we favour developed markets, and I think what I would do is I would look at from an investor with a portfolio already, I would look at what gaps I had in my portfolio. So if, as a lot of investors have been very underweight Europe, because of the debt crisis and the financial crisis in peripheral Europe, there might be an opportunity to top up into a European holding. Also, we tend to find UK-based investors very underweight US. Now, the US stock market had a very strong year last year and certainly no longer looks cheap. But if I didn't have any US, then maybe a US holding or one of the global funds I mentioned before, because global funds tend to be around a half invested in the US anyway. So actually a global fund does get you some exposure to the US market. I also quite like technology. Technology is a very different beast from the heady days of the TMT bubble in the late 90s, early noughties. You know, you're now talking about mature companies like Microsoft and Apple. I mean, these are very, very large companies with huge amounts of cash on their balance sheet. And some of them actually do look quite interesting. And as a sector itself, technology is not overvalued at the moment. So that's one I think I'm keeping a personal eye on for the current ISA season.
Okay, and finally, if I had a long-term investment horizon and I wanted to take quite a bit of risk and I was quite prepared to describe myself as an adventurous investor, is there anything that you think might be good for this season?
Yeah, I mean, I think, as I said, valuations on emerging markets and Asian equities are generally cheap. So if you wanted to broaden Asia portfolio or an Asian fund, you could consider something like First State Asia Pacific Leaders or Schroeder Asian Alpha Plus. If you're looking for emerging markets, we like M&G emerging markets or global emerging markets funds. And if you're really looking to push the sort of the boat out on the risk scale, you could pick a single country fund, something like Neptune Russia. I mean, Russia really is extremely cheap market, but it's cheap for the right reasons. It's got a lot of political instability and political interference in the way those companies are run. But if I was prepared to take a long-term view, if you're buying Russian equities today, in aggregate, they are very, very cheap.
So some options there for investors to think about this ISA season. Thank you, Darius, for talking to Mindful Money today.
My pleasure, John.